In recent years, you may have noticed the rise in popularity for index funds and ETFs, which have given rise to a new class of passive investors. Now the question is raised. Have index funds entrenched themselves into financial markets, or are they just another bubble? First of all, what is an index fund? An index fund is a managed fund of stocks picked in such a way that it will mirror the movement of indices such as the Dow Jones Industrial, the S&P 500, or the Nasdaq Comp. Typically managed by specialized institutions, investors need only pay a fee of typically around 2% for their investment. An ETF follows the same philosophy of tracking an index or industry, but can be traded like a stock. The ETF has now been accused of behaving like a bubble by many experts, including Michael Burry, the man who foresaw the subprime mortgage crisis in 2007. In his logic, the ETF is a security which warehouses both high volume traded stocks with the low volume traded ones. It functions very much like a collateralized debt obligation, a CDO, which mixed mortgages with stable repayments with those that didn't. As soon as these subprime mortgages began defaulting due to adverse economic conditions, CDO holders perished. For these ETFs and index funds, this warehousing carries many serious problems. How will the presence of stocks with lower daily trading volume affect the overall liquidity of an index fund? As more of the market get tied to these funds, what will happen if a surge of investors want to cash out? How will the distribution and management of 300 to 500 or so small and large volume stocks in a typical index fund be influenced by this? Essentially, an index fund is a theater that's getting more and more crowded without having more and more doors. What will happen if someone starts a fire? However, like what happened with CDOs during the global financial crisis, the trading of synthetic ETF products are likely to do more harm to the economy than the underlying physical ETF. Essentially, synthetic ETF products allow the parties to trade something that behaves like an ETF without ever interacting with one. Essentially, it allows greater exposure to ETFs without having to create more. Typically, this synthetic ETF is made of swap contracts and derivatives. Its main benefit is that the parties don't ever have to deal with the taxes associated with equity trading, as well as the opportunity to punt on ETFs without owning one. The problem with synthetic ETFs is that it creates limitless exposure to ETFs, meaning more and more people can punt on ETFs without holding one. As we know, the stock market is currently on a 10-year winning streak. The longer this goes on, the larger the synthetic ETF market will grow, until one day the stock market reverses. Such was the case with mortgage-backed securities and the US housing market crash in 2007. A US housing market crash back then was a contrarian opinion, as with a stock market crash now in 2020. The US government, through the SEC, prohibits the creation of most of these securities, but in Europe, synthetic ETF trading is on the rise. While ETF trading may not spark a market rout, it is possible that it will exacerbate one. In other words, make a large market correction worse. As March stock index movements during the pandemic show, massive record-breaking percentage falls occurred one after another around the world. The Dow Jones Industrial lost almost half of its value within a month, only to be reversed when the Fed does what the Fed does best, and that's injecting trillions into the economy. Despite these events, the ETF and the index fund continue to exist as passive investors return to the stock market.